Hello, everyone, and welcome to Fundamentals. Today, we bring to you the much topic at this time of the day, which is precious metals, and we discuss gold and silver. The tightening of the monetary policies by most central banks seems to be coming to an end. The geopolitical uncertainties are on the rise, the global growth seems to be slowing, and the dollar index seems to be cooling with respect to last year. The increased penetration of EVs and solar panels also stays high in demand. There are many more variables which seem to have an impact on gold and silver. To understand this and much more on this space, we are joined in by Mr. Vikram Dhawan. Vikram is the head of commodities and fund manager with Nippon India Mutual Fund. So my first question to you is, what is your house view as far as gold and silver is concerned?
So gold, and specifically gold, and if you, well, we also have silver. I think last time when we spoke, there was not a silver product available. The it is a long-term asset allocation story as far as investors are concerned. I mean, anytime in the past, whether it is 5 years back or 10 years back or 20 years back, markets, all capital markets have gravitated to the other extreme. Either they have made ridiculous highs or ridiculous lows. And even, one more factor which has actually come in recently, post-COVID. I mean, earlier you could believe or you could trust the central banks to get it right. But what we saw in the US, as far as the inflation is concerned, it is sort of, now we are actually in a situation, in a time when you have to actually guess what the impact of the central bank's action would take, which perhaps is a new thing which I'm seeing after having spent about 2.5 decades in the market. And also I mean, if you see the last few statements of the U.S. Federal Reserve, which is so important for the the global monetary policies and currency directions, they have gone to what they call is a data-driven. This is what the analysts do when they analyze the stock. So there is no forward guidance by the central banks across the world. They have taken this sort of a defensive position. So what it does is it sort of creates a lot of uncertainty on the path of the interest rates, which again affect the economies across the world, local economy if it is US or India or China, and it also feeds into currency volatility and inflation. So we are actually in a brave new world where the we will the investors are very good thing is the investors are very willing to climb every wall of worry. But we have seen this movie before that global economy, global markets are very cyclical, and you need to diversify. As they say, don't put all your eggs in one basket. And gold historically has been one of the asset classes, I would say a go-to asset class for diversifying your portfolio. So I think as far as the long-term, view of gold is concerned, obviously, specifically in case of India, where we run a chronic, capital account deficit. Now there are certain, again, the short-term view on rupee and the long-term view on dollar or whatever it is one aspect, but I think my belief is, in my personal opinion, if the economy has to grow, become, one and a half, twice the size, in absolute term, as a percentage of GDP, the CAD may not increase significantly, but in absolute terms, we are looking at much larger numbers going ahead. So, keeping all this in mind, we remain very friendly towards gold as a part of the asset allocation story and, portfolio diversification.
So this brings to me to my next question on the way central banks have been, the buyer of gold every single year for the last decade, and the pace and intensity with which they have bought gold, has been, I think, the highest since the last 1960s that we are witnessing right now. So, and look at any economy, be it China, India, Russia, Turkey, the action of most central banks seems to be more on the accumulation of gold. Now, my question to you is that what could be the potential reasons for the same? And do you see this cooling off anytime in the near future?
even today as we talk, the dollar component of the central bank reserve is still close to 60%. And in the past 10 years, the world has changed a lot. We are now talking about at least two blocks, whatever you want to call it, the US block or the China block or the neutral block, whatever. So we are moving towards a situation in which, there is an urgency and there is, eagerness to sort of challenge the dominance of dollar. And obviously, when you are not friendly towards dollar, you will not like euro and yen also, because they are part of the Western sort of, the Western bloc, if you would like to say. So where do you go to? I mean, you can buy as much yuan and you can buy as many rubles and rupees, but you have to remember these currencies are not convertible. I mean, there is no spot market, global spot market for these currencies. Also, what has also happened is that with the de-dollarization, again, it is something which is not going to happen in few quarters or few years. It's a generational thing. But as and when the de-dollarization picks up, the transmission of the US monetary policy will lose its effectiveness. So, there is a good possibility, we may move towards the pre-globalization eras where, global economies, large regions may be out of sync. And in that case, not only it makes things very interesting for the investors, but it may lead to a lot of, capital markets and currency volatility, as to say. I mean, just to give you an example, Russia, because of, dodging the sanction, has got now close to about 200 odd billion dollars of yuan and roughly about $100 billion of rupee. And there is no open market for that. I mean, tomorrow, if they want to dump these currencies or exchange these currencies, there's nothing available. And same for China also. I mean, they remain opaque. So does Russia. So of all, they may be having some reserves of rupee and ruble, as the case may be, but there is no spot market. These currencies are not convertible. So, and there's a talk about the BRICS currencies. So, their gold becomes very valuable asset for central banks. A, it doesn't have a credit risk, and B, there is a ready spot market. And if you see the volumes of gold, the daily or weekly or monthly or annual volumes, it is amongst the top 3 or top 5. I mean, top must be S&P 500, maybe US Treasuries, and then maybe 1 or 2 more indices, and then comes gold. So it is one of the most liquid asset classes. So that's why they want to hedge their bets, and their balance sheets are expanding. If you look at the balance sheets of the central banks across the world, even in India also, it is close to about 20, 30. I don't know the exact figures because they come with a lot of lag, but most of the balance sheet of the central banks are close to anywhere between 15% to 35% of the GDP. So that is the kind of reserves the central banks are carrying, and it will only take one more, down cycle in the economy to increase the size of this balance sheet. So yes, I'm not saying that, central banks will be loading up on gold even this year also, because last year was something phenomenal. I haven't seen in my entire career. I mean, they bought close to about 1,300 tons of gold, which is roughly about 25-30% of the total demand. Will we see that again this year? I don't know, but I think what will definitely happen, and definitely what we are seeing, is that central banks are coming in whenever there is a price correction. I mean, yesterday was an example. There was, and all what you have to also appreciate is the entire gold rally has been with complete absence of the investors. There has been absolutely no increase in the AUM of ETFs across the world. I mean, thankfully, it looks like the Indian investors are smarter than their peers outside. We have seen, well, it's not a deluge that we have seen in India in the gold ETFs across the industry, mutual fund industry, but yes, we have seen at least some flows coming in. So yeah, very interesting times, and you can take it this way or that way, but fact of the matter is that there are too many balls in the air, right now for the global economy and the investors and the macros.
This brings to me, on my question as far as the Indian investor is concerned. Now, if you see the way the gold prices are constituted for the investor, still tax, it stands at almost 18%, and out of which 15% is just import duties. Now, with the current account deficit being a little benign as of now, do you think that, any reduction in import duties could be one of the biggest risks as far as the Indian investor is concerned?
I think it is we have a love-hate relationship with gold. As you saw that during pandemic, which was visible in the business of the gold companies, the gold loan companies. It's one of the reasons I always say that we always have. I'm so sorry for my throat, bad throat. One of the reasons why Indians absorb the global economic shocks better than their peers is because of the gold holding. I mean, by conservative estimates, we are holding roughly about $1.5 trillion to $2 trillion worth of gold. And you can imagine that a 10%, 20%, 30% appreciation on that, it creates so much of wealth for them. It creates a buffer for them. And, so that is the love relationship. But the hate relationship is that we absolutely, certain part of the establishments, whether I'm not talking about government specific, but I've seen this story for the past 20, 30 years that there is a certain thought process in every establishment which hates gold. They want to decrease the consumption. They want to put duty on it. So I think, as they say, the twain shall ever meet or not, we don't know. But, this is a big paradox. And what has happened is because of this paradox, even though we are one of the largest buyers of gold, almost close to China, we don't have any say in the global markets because it is a one-way market. You can only buy gold. You cannot export gold bars. And secondly, you are not a price taker. We are still dependent upon whether it is London or UK for the prices and all those things. So I think this is something which needs to be resolved. I must appreciate the efforts of the present government. They are looking into gold in a more rational way, in the sense they have started a gold exchange in the gift city. But I feel there's a lot to be done on this. So I think the Indian investors have absolutely very little choice, because see, if you buy gold in dollars, then you are overseas, you lose the benefit of rupee depreciation, which has been in the past 20, 30 years in the range of 3 to 5%. So it's, I would say that, there are not many options as far as the Indian investors or Indian gold buyers are concerned. With regards to duty reduction, again, I said that, there is a paradox has to be resolved, whether we consider gold to be a bona fide asset class along with equity and debt and real estate. Unless that is resolved, I don't see any meaningful, reduction happening in the duty. You may have a 5% here and a 5% there, that's about it.
Understood. And since you were mentioning about asset classes, and there's one more part of precious metals which we didn't have access to in a paper form till about 3 years back when we discussed last, and that is silver. Now, I have 3 questions pertaining to gold and silver. So one is for somebody who has a growth profile and is a little aggressive in terms of portfolio construct and has a long-term view, what percentage of gold and silver would you recommend in the portfolio? That is question number 1. Second, we see a lot of analysts tracking gold versus silver ratio as far as pricing is concerned. So at what ratio should one skew the portfolio toward gold, and at what ratio it should move to silver? And third part of my question is that at current prices, are you more biased toward gold or silver, or are you neutral?
The first question I'll take first. Ultimately, one of the jobs that we have, and especially Ashok and his team and Dev and his team has, is to understand the philosophy of the investor. Well, it is very difficult to reach every investor, personally, but it is very important to understand their philosophy, because if you don't have a philosophy, then, as they say, if you don't have a direction, you'll end up anywhere. Now, if your philosophy is about, just to give you one example. Now, we've all heard this story many times. Compounding creates wealth. Now, how does gold help in compounding? there's no point having a very aggressive portfolio which is up 40% 1 year and then 30% down next year. It will give you no certainty in compounding. If you diversify it with, I'm not saying gold, it could be fixed income or gold or whatever, overseas equity or whatever is, the more you diversify, maybe in absolute terms, there will be certain asset classes which may be ahead of you a little bit, but you'll have a certainty of compounding. So that is one philosophy that the investors should have, that am I in this market for long-term compounding game or am I here for short-term gratification? I mean, there are absolutely no models or no sort of formulas for short-term trading. I mean, I wish we all had it, so there was no need to build the entire mutual fund industry for that. So that is one thing. But I think just to go slightly a level lower than that, if you are a conservative investor and you are, like fixed income more than equities, when you can't stomach the volatility in the risk assets like equity, then gold becomes, gives you two things in your portfolio. One, it is protecting you against some sort of a credit event which happens in the fixed income market, which may, make the yields go haywire. And secondly, historically, again, this is something that we need to qualify very, very strongly, that just because gold has given long-term returns of 11-12% CAGR in INR terms, there is no guarantee that it will continue. But purely if you are somebody, analyzing a past data, then for a fixed income portfolio, gold becomes more of a, sort of a yield enhancer or a volatility enhancer. Now, if you are somebody who likes higher risk reward ratio and more skewed towards equity and mid caps or small caps also, then gold is one of the hedges that you will get over there, because equity markets will only become volatile if there is some economic sort of downturn or economic event or a black swan event. So there again, it will help you in both the cases. It helps you to tide over those volatile times and keep your compounding story relatively intact vis-a-vis, fixed income. Maybe people don't in today's, again, I have a few slides which I'll show in the end. In today's inflationary environment, fixed income is something that maybe the institutions like it because of the risk, but for an individual investor who's on the ground with higher inflation may want to have slightly higher risk profile in their portfolio. And again, if you move to equity, then you have all these cycles in equity and all those things. So I think both ways it affects you, and I think that should be the philosophy. First, you distill the philosophy that you want to have on why gold, and then second, then you can move into it. Or you are somebody who have in a happy situation, you have a lot of cash to invest, and you don't want to time the market, you don't want to take a view on the market, then you can put your money straight away into a multi-asset strategy or a fund or whatever, where you have gold also, fixed income and all those things. So yeah, these are the things that sort of should be the philosophies which will affect your the allocation to gold. But just to give you a data point, some years back, World Gold Council had done a study, and again, it's something that we are not trying to sell or subscribe to it, but they had done a study, World Gold Council, and they said for a typical Indian pension portfolio, if the allocation is below 5% or above 15%, it is suboptimal for the portfolio.
And that was a very good range you gave us, 5 to 15, and most of our investors would also have a similar allocation in gold. Now, you mentioned a lot of concepts like philosophy, long-term compounding, and the question is pertaining to that. When we look at the construct of mutual fund industry in India today, we have around 14,000 crore coming every month in the form of SIP. Now, SIP's purpose is to tide over volatility, but when we look at gold and silver both, they are extremely low volatile in comparison to equity, though they are much more volatile in comparison to fixed income. But we see a long-term behavior of gold remaining constant or range bound, and then all of a sudden in a year or two, it goes up significantly. And at that time, the return and the volatility both increases. Now, if the behavior of the asset class is two ways, where it remains stagnant for a long period and then it jumps, Shouldn't gold be looked as a tactical allocation instead of strategic asset allocation?
That in India, the asset allocation story and multi-asset strategy story is actually very nascent. Whereas if you go to China and if you see the launches which are happening across the world in the past few years, you will off and on you'll get those asset allocation and diversification funds which are coming up. And it shows in the AUM also. If you see the AUM of the multi-asset fund, it is barely 2% or 3% of the entire AUM. So I think, as I mentioned, whether it is a lack of education, something which the mutual funds need to do more, whether it is the investor philosophy of being more tactical and more, FOMO also, sets in with a lot of people. But fact of the matter is that the asset allocation story or multi-asset story in India is very nascent, but very promising, because I think, the current, sort of the kind of flows we are getting, and as the market develops. So what you have to appreciate is that when, portfolios become bigger, only then people talk about asset allocation, because the cuts can be very big. It's for a small portfolio, even if you lose, you can even put it in Bitcoin, you can lose all and you not worry about it. But as the portfolios become bigger, as the wealth creation becomes bigger, and we are seeing the effect of that in the flows, and recently, as we in the past few quarters and past few years, if you see the flows into the multi-asset funds or the asset allocation funds in the past few months and few years, they have actually started picking up, which is a very good sign, and which is an indication that the market is evolving and people are getting more richer and bigger, and they want to have more diversified portfolios in their sort of within their families or a personal or whatever it is. But coming to the tactical play, well, every asset class is open to tactical play. Why gold? Commodities, equity, debt. People take tactical plays in everything, which is something which I think probably is more the nature of the investor. Whether they want to generate some returns or generate some excitement also with the returns. So that will depend upon that. But I think what you have to also appreciate is that gold is something which has been around for thousands of years. So if you want to take a tactical call in gold, you better be ready to have a long-term view of 3 to 5 years at least before you can get it right or make significant money. As you rightly said, gold is less volatile compared to equities. If you compare the gold volatility with the S&P index, which is a diversified index, gold will slightly be better, if not significantly better than that. So I think that's where the argument lies. As I say, I rest my case as far as this tactical play on gold is concerned.
Mentioned about 3 to 5 years for tactical play, while for most of investors, 3 to 5 years is a very strategic time period and not a tactical one. And that's how the nature of the market has become. So Vikram, before I move to the next question, there are two aspects of the previous question which got missed. One was on gold to silver price ratio. And second, at these level of prices, what would you be biased toward, gold or silver?
So I think you will have to now differentiate between gold and silver. The gold-silver ratio had its significant. It is still significant, but you have different forces pulling the two precious metals right now. As I mentioned, the pull for gold is more from strategic point of view from central banks. That is where the pull is coming. Investors have been completely out of the game in the past 2 years. They've missed the entire rallies, except perhaps in India where we have seen flows. That is a pull for gold. The physical demand remains robust. And as the economies, when we talk about the Indian economy growing and the Chinese economy growing, it also means more jewelry demand, more physical demand also. So if we were to double the Indian economy today, let's say with a magic button, I'm not saying that the gold demand will double, but there's a very good chance that it will at least increase by 50% to 70% as the case may be. All very basic back of the envelope calculation. So we have, as I mentioned, we continue importing gold. So does China, despite the central bank buying, irrespective of what is happening in the rest of the world, in other markets. The demand is very much there. Now, if you look at silver, what are the forces pulling silver? And I have a few slides which I'll share in the end of the presentation. Silver is being pulled by the green, so-called the green tech. Today, solar accounts for roughly about 10, well, the entire industrial, out of the entire industrial consumption of silver, which is about 55%. And in gold, the industrial consumption is hardly 2% or 1% or even less also. In silver, it is about the industrial part of the consumption pie is about 55% and growing. And the growth is coming from the so-called green tech industry. It's EV, it is 5G, it is solar. And last year we imported, we consumed roughly about 10,000 tons of silver. Whereas if you see the long-term, the consumption of silver in India has been in the range of 4 to 7,000. So where is this silver going? I think it goes without saying that a good part of the increased silver demand in India, and that's I'm talking about India, I'm not even talking about China, is going into the green tech story, whether it is 5G or whether it is EV. And solar is something very big. I think we have chosen solar as to be the solution for managing our greenhouse emissions. So these industries are pulling silver on the upside. The difference is that the green tech industries, come what may, we have had one mini bust of Nasdaq, but see where Nasdaq has bounced back to. So the technology story is alive and kicking. It will just go through cycles. There may be short-term, hiccups if the Republicans get elected in the US, then they are anti-woke and anti-green agenda. So you might see some, but it is inevitable. Again, I can share some slides on where temperatures are going and what's happening in Antarctica and Arctica and Arctic, spheres. So this is where the pull is coming from, and these industries even now remain by and large blank check industries. I don't think they have that much of pressure on ROI or ROE or ROCE than the traditional industries are concerned. So you could have a situation and you have a silver market which is either in balance or in deficit. So so that is where silver is. So there are two opposite forces which are pulling gold and silver up. So that is why you will see, but the significance of the gold and silver ratio tells you that which metal has outperformed or underperformed the two. But I think if you're talking about gold and silver, it is not gold or silver, it is gold and silver. And obviously silver has a higher beta than gold. That is how you'll have to play the market. Also, I think the biggest mistake the data analyzers do or the investors do is they look into the 10-year period from 2013 to 2015 when gold and silver prices collapsed. So when you take those 6-7 years into account, it doesn't make sense to keep that into portfolio. So you have to look at it from what is going to happen in the future and then take a call on gold and silver.
Next question is about mode of investment. And today investors are spoiled for choices. Now, in good old days, we used to compare physical gold versus paper gold, which most of the investors are aware about. But within paper form of gold, we have so many options today. You have digital gold, you have SGP, you have ETF, you have gold index funds. So as an investor, in which situation do I prefer which option? So if you could guide us on that.
Sure. So I think if we all have now Amazons or Flipkart in our phones. If you take out the how much a gold bar, physical bar is selling in Amazon, and just compare to the landed price you're getting in ETFs, and you'll be surprised at the difference of that. So, and that is why ETFs, gold ETFs and silver ETFs have been one of the best inventions of the financial industry in this century, because you're able to buy very small amount of gold, at very high liquidity and with minimal impact cost. I mean, obviously, if you were to buy a gram today, if you were to buy a gram of gold from anywhere, from a jeweler or Amazon, the impact cost can be in double digits at least. So, that safely, makes ETF as one of the, best, sort of investment vehicles for investors. There are other options also, digital gold. Now, digital gold is actually gone the Bitcoin way. They have, not been proactive in getting themselves regulated. And I'm not saying they're bad, but I think anything which is not regulated cannot be scaled up. I mean, one of the reasons why mutual funds are where they are is because we have a regulator SEBI, which has been, well, you may squeal, you may complain, but fact of the matter is that, unless there were this many regulations, it would have been very difficult to scale up this market. So I think digital needs to do their bit as far as scaling up the market is concerned, otherwise it will always remain in the fringes. And as far as gold bonds are concerned, I think, I always tell investors that, the more wealth is made about, timely exits than timely entries. So, as you mentioned that gold has got low volatility, but still it is long-term volatility of gold is about 8 to 9%. So any asset class which has got X or Y, standard deviation of returns, it will always make sense for you if you're held it for a long term to, look to it. I'm not saying you do that. I'm not giving you a formula to make money, but I think whenever something is moved by 1 or 2 or 3 standard deviations, it has always been a good time to sell, as the case may be. Now, that kind of liquidity you can only get in gold. I mean, tomorrow, if there is, I mean, we saw what happened in the pandemic, and gold ETF, despite all the blocks and coming above the value chains and supply chains, were pretty much relevant, and people were buying and selling, as the case may be, gold ETF units. So I think I'm not saying don't buy digital gold or don't buy gold bonds, but if you're using gold as a hedge, as an insurance policy, then you need to be very careful that it is in a liquid form. Otherwise, it should not happen that, when you need the gold most in your portfolio and you cannot sell it. So I think that is what I mean, I'm sorry, I may be a bit biased towards gold ETF, but actually in my personal capacity, I've tried all these things, buying and selling digital gold and buying and selling gold bonds, just to see that what is the impact cost. And I've come to a conclusion, yes, they also have a place in the gold industry and they will have a place. But I think if you are somebody who believes in capital markets and portfolio diversification and asset allocation, then you need to have a liquid form of gold, and most liquid form of gold that you can find anywhere in the world, not just in India, is gold ETFs.
That is a very candid reply, and thanks for that. Now, Vikram, with this, we come to the end of our discussion. And while you will be taking us through a couple of slides to give us a better perspective, there's one last question which I have, and that is about understanding the risk. So what are some of the risks which investor in gold or silver should be tracking? And we generally use gold and silver for hedging, but if we have to hedge the risk of gold or silver, what are the options?
So I think first of all, the investors should see the long-term data. I mean, gold versus fixed income, gold versus equity, gold, how gold has done in, complete risk on environment and risk off environment, and, see what is the worst and the best case scenario as far as gold is concerned, and be aware that, the reason why we are discussing it, because we don't know what's going to happen in any of the markets. This is the beauty of our markets. The uncertainty is what, gives us the innovation and the heft or the intellect or whatever you want to call it to, sort of keep on working towards, making, I mean, I always tell people that, the best job in the world is not managing money, but the best job in the world is making money for other people. So, we'll all keep on working towards that. So I think you'll have to see what is the worst gold has done in a given period. And I always tell people that if you could have stomached the volatility between 2013 and 2015, if you can stomach that in gold and silver, then perhaps, it is probably the black swan event which happened in gold in the past 20, 30, 40 years, as the gold may be. But yes, again, every asset class has a long-term trajectory and a short-term trajectory as well. equity will have its own long-term returns, fixed income will have its long-term return, and so will gold. So the best way to take advantage of these, all the asset classes, is to be in it for the long term. As you rightly mentioned, that 3 to 5 years is actually the least, the investors should look at in terms of horizon, for even for strategic, portfolios. So you can only do that if you have some sort of a long-term strategy, a multi-asset strategy. And the beauty of a diversified portfolio is that whilst the returns may be reasonable, but the volatility of the portfolio will be a lot less than the frontline markets, even the indices. So, I maybe something that you can do, you can see the volatility of a NAV of the diversified fund vis-a-vis volatility of Nifty or Bank Nifty or small cap Nifty, and you'll see the difference is significant. And that is where two things come in. The hedging part is being taken care of, and also the compounding part, that even if the worst were to unravel, at least, you will not go down. So it's basically, when you have a diversified portfolio, anyway, your portfolio standard deviation will come down. So I think that's the best way to play this market.
Totally understood. And before we end, Vikram, if you could just take us through a couple of slides which you had prepared and which you wanted us to go through.
Sure. I'll just show you a couple of slides, and I think that will sort of tell you what's happening in the market. So this is the inflation, global inflation. This is the Bloomberg data, which covers about 80 to 90% of the world. You can see the long-term inflation, very rarely it has gone about 2, 3, 4%. And look where we are, even after correcting, it went to almost 9.5, 10%, and it's at 6%. The good news is that the inflation is coming down. But see, look at, and this is the slide which tells you the interest rate curves of the globe, the various economy. The green one is US. This one is China, this is Japan, and this is India. So as you can see, while the weighted average inflation of the world is still about 6%, but the weighted average interest rates of the world are still below 6%. So, people are getting it wrong when they're saying that, markets are rallying because, Fed will stop the, it's not that. And if you actually see the fine print and hear what Jerome Powell is saying, he is hinting that the rates are still either close to zero or still in the negative territory, real rates. And it is no rocket science why the risk assets are rallying. Now, the Goldilocks scenario is that before there is a significant slowdown in the global economy or any of these countries or region, the central banks will have the nimbleness to cut the rates and ensure there is no recession or some sort of economic, crash or whatever you want to call it. But that remains the Goldilocks scenario. I mean, these are all very educated people. We should not second guess them. But this gives you an idea that where we are as far as the global macros are concerned. One other slide which I'd like to show to you, anybody who's skeptical about the climate change, just see this slide. This is Antarctica. So it's Arctic is up, Antarctica is down. Thanks to National Geographic, I know it. Just see the red line. This is the ice available right now, and it has gone beyond 3 standard deviation. So the melting of the ice is no longer, I mean, if you talk to a environmentalist, they are actually, being very, very hyper, and they are, sort of, telling you the doomsday scenario. But the climate story is, maybe it has not come to your doorstep or my doorstep, but it has reached a lot of doorsteps, and it's just a matter of time. And hence, silver, and hence the EV and all those stories that come into your mind. But obviously, as I mentioned, it will never be a smooth exponential ride for any of these things. That is one slide I wanted you to see. And the other slide which I wanted you to see was, just a minute. Yeah, this is another temperature, as you can see, all-time high. Just a minute. Yeah, so this is another slide I wanted you to see, that, when the solar story started, the consensus view was that let us make the solar panel cheaper by using less silver. But what you have to understand is that land is also an asset. When you have solar, it is on land, which is also an asset. And in some countries, land is at a very high premium. So now the philosophy is changing, and they want the solar panels to have a lot more silver so that they are able to generate a lot more electricity per square inch or square millimeter, as the case may be. Yeah, so this is something which you need to do. Compare the rates. I'm not Okay. Last but not the least, this is a study done by World Gold Council. It's a very excellent website they have, and this shows you how gold is performed. How negatively gold is performed with comparison to stocks and the other asset classes. So yeah, so I'll take a pause over here, and if you have any other questions, I'll be very happy to answer. Well, a lot more to discuss, but it becomes unending and tedious for people to listen very long discussions also, as I understand.
Thank you so much. Actually, these are very enlightening slides, and thank you for putting in effort to show us these. And with this, we come to the end of our conversation, and it was a very enlightening conversation on a lot of fronts. We thought when we started this podcast that it would be about gold and silver, but we discussed about changing Fed behavior, de-dollarization, balance sheet of different central banks, ETF AUMs, Indian investors versus foreign investors, asset allocation, climate changes, and exit strategies. And we never anticipated that we would end up discussing all these concepts in a discussion on precious metal. And that's thanks to your wisdom and experience that we were able to get those inputs as well. With this, we end our conversation. Thank you so much for taking out time on a busy day and helping our investors understand the nuances of precious metal. We often meet our investors and we tell them that, when we read stories which were 1,000, 2,000 years back, kings used to hoard gold. And now we have reached again a full circle where central banks are hoarding or buying gold. And that's how the nature of life cycle is. And that's where gold is, 1,000, 2,000 year stories and not a 1 to 2 year story. Thanks so much and really appreciate your time and your inputs.
Well, thank you very much, and thanks for inviting us. Thank you very much.